Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone and welcome to the weekly Through the Noise podcast. I'm Michelle Kam, investment strategist from our CIO team. Following the Fed's FOMC meeting 2 weeks ago, the US government bond yields have been surging to the highest level since 2007 last week, and after that we're seeing the largest ever US government bond bear market set new low this week, dragging down stocks with it. With such an environment where market volatility is rising and investors are increasingly risk-off, how should we navigate in such a market dynamic going forward? Joining me on today's podcast is Raymond Cheng, our North Asia Chief Investment Officer, to unpack for our listeners the week's market events and share our latest thoughts on them. Hi Raymond, given how the US government bonds have tumbled over the past week, do you think the rout is now over, and how should we position our portfolios?
Thanks, Michelle. The Fed will inevitably maintain its higher for longer stance if inflation and oil prices remain elevated and the US job market stays resilient. In other words, a hawkish Fed and continued rise in US fiscal deficit sustain the risk of higher bond yields in the near term. However, three key trends support our view that we are getting closer to the peak in bond yields than we are to the bottom in equities. First, inflation is moderating. US core PCE inflation in August slowed to below forecast of 0.1% month on month. September's CPI inflation data will be released next week, with consensus expecting core CPI to moderate further to 4.1% year-on-year. Moderating inflation will give the Fed the flexibility to hold rates for the rest of the year. Second, economic activity is cooling. Services PMI in September trended down to 50.1. We are concerned the resumption of federal student loan repayment this month and high gasoline prices will impede consumer spending. Also, we have been getting mixed signals from the job market throughout the week. While job openings rebounded, ADP, private sector job creation, came in notably below forecast. A cooling job market, if it materializes, would help prevent the Fed from hiking further. The third factor is political uncertainty. The political deadlock in the US Congress following the ouster of House Speaker Kevin McCarthy reduces the risk of higher fiscal spending and deficits, at least until next year's presidential elections. Persistent political uncertainty would add to hard landing risk. Now, on the other hand, let's assume the scenario that yields don't peak. If rates stay higher for longer, risks of a deeper recession are likely to rise. Then bonds will likely outperform stocks over a 12-month horizon. The 10-year US government bond yield at 4.7% is quickly catching up with the S&P 500 earnings yield at 4.8%. The earnings yield is the inverse of the price-to-earnings ratio. Given the uptrend, bonds are looking more attractive than equities. Also, US equity market technicals are at a pivotal level. A break in the S&P 500 below the 200 daily moving average would extend the sell-off in equities. History over the past 50 years shows us a rapid surge in bond yields has almost always led to a financial accident or crisis. It would be unprecedented if the biggest bond bear market in US history we are facing right now did not lead to one this time. Now, based on this assessment, our investment recommendations are threefold. 1. Take some profit from equities and average into high-quality developed market government bonds. 2. Remain selective in equities. We favor the US and Japan among all geographies. Sector-wise, we prefer technology and communication services in the US. Both sectors have seen upward earnings revisions and have defensive qualities. We also like the US healthcare sector that offers a defensive hedge. 3. Gold looks technically oversold at these levels and is testing its 200-week moving average. We would suggest clients change into gold with our 12-month price target at 2010 US dollars.
So you've just mentioned the rapid surge of bond yields. How high do you think the US government bond yields would go?
US 10-year and 30-year government bond yields touched 16-year highs of 4.88% and 5% respectively this week. The term premium measures the additional compensation investors demand in return for holding long-term bonds, and this measure rose further over the week. US economic growth has been resilient, with the Fed's latest estimate suggesting 2.5% as the appropriate neutral policy rate. Current elevated bond yields are telling us monetary policy has significantly tightened. Looking forward, we expect consumption in the US to soften as higher energy prices and repayment of federal student loans reduce disposable income. While near-term momentum could push the US 10-year yield to test the 5% threshold, we believe yields are starting to look stretched. If yields rise further or even stay at the current elevated level for a prolonged period of time, it would increase the risk of a deeper and more prolonged recession in 2024. Now, for investors with medium to long-term investment horizon, we think current levels offer an attractive opportunity to average into long maturity developed market investment grade government bonds.
Got it. So let's shift into equities. With the US third quarter earnings season coming in a week's time, what is our outlook on that?
Yeah, indeed. US Q3 earnings will begin with some major US banks reporting on the 13th of October. Now, after the expected trough in earnings in Q2 this year, Q3 is expected to revert to positive year-on-year growth of 1.6%. Earnings growth is expected to accelerate thereafter, with the next 4 quarters from Q4 this year to Q3 next year registering growth in the range of 10 to 13% year over year. Now, such acceleration in earnings growth supports our view of US equities outperforming global equities as a whole over the next 6 to 12 months. On a sectoral level, Q3 continues to see a wide dispersion in earnings by sectors, from negative 35% expected for the energy sector to up 34% for communication services. The market will be also interested in comments from banks on the implications of rising bond yields to their bond portfolio losses and earnings. Now, looking at consensus earnings since July this year, the S&P 500 has seen a positive upward revision in earnings growth, from 1.3% to 2.4% this year, and from 11.7% to 12.1% in 2024. Now, on a sectoral level, only 2 of the 11 sectors have seen similarly positive revisions since July this year for both earnings growth this year and next year. Now, these 2 sectors are technology and communication services. The strong earnings momentum reinforces our overweight view on these 2 sectors. And as we said before, we also prefer the healthcare sector as a defensive hedge.
So moving on to China, the Golden Week holiday have started last week. What impact do you think the China's Golden Week holiday spending will have on local equities?
Yeah, the holidays this year has seen a substantial recovery in tourism compared with a year ago, but the activity still remains below pre-pandemic levels. The passenger travel volume in the first 7 days of the holiday was 35% below 2019 levels, but 55% higher than a year ago. Data from Macau show total visitations in different casinos in the first 6 days of the holiday were 14% below 2019 levels, but almost 5 times the level of 2022. Now, we expect such rebound in China's tourism and policy support to bode well for a gradual recovery in consumer spending in China and earnings for names related to the consumer discretionary and communication services sectors. These two sector exposures are the industries we favor within China equities. The structural issues around China's property market remain a headwind to economic growth and investor sentiment. As a result, we are neutral on China equities within Asia ex-Japan over a 12-month horizon, despite a deep valuation discount and light investor positioning. At a broad index level, technically, the Hang Seng Index in Hong Kong has reached a new year-to-date low earlier in the week and is seeing positive divergence, with the Relative Strength Index or RSI holding up. This raises the prospect of a technical rebound for the index. The next technical support is around 16,830, a level that held on trading days seeing high volume back in November a year ago.
Thank you so much for your insights, Raymond. So to conclude, we believe the Fed is likely to maintain its higher for longer rates mantra, while we are also seeing attractiveness of bonds over stocks as we are nearing to the peak of bond yields than we are to the bottom of equities. So going forward, apart from the US earnings season, we'll also watch out for key releases of the US CPI data and also Fed minutes due next week. Here comes the end of this week's podcast. Thanks for listening and wish you have a great weekend ahead. Thank you.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.